My husband's attorney slid the settlement agreement across the conference table on a Thursday morning in February, and my husband, Mitchell, watched me read it with the specific expression of a man who believes he has won something. The agreement gave Mitchell the house on Carmichael Drive, the 4-bedroom colonial we had bought at 28 with the mortgage we had taken out at the peak of the rate cycle, and that carried a monthly payment of $3,100 and a balance of $412,000. It gave him the joint brokerage account, which had $67,000 in it, and a capital gains tax liability I had calculated at approximately $18,000 due in April on trades Mitchell had made the previous year without consulting me. It gave him the 2 cars, the BMW he drove and the Subaru I drove, both of which were leased and neither of which would be owned by anyone when the leases ended in 14 months. It gave him the home equity line of credit, which had been drawn to $88,000 to fund the home renovation Mitchell had insisted on in 2021 and which was accruing interest at the current variable rate. It gave him the furniture, which was ours, and the tools in the garage, which were ours, and the grill on the back porch, which was ours, and the kitchen appliances we had registered for at our wedding, which were ours. What the agreement required me to relinquish was my claim to all of the above. In exchange, I received the joint checking account, which had $4,200 in it. I read the agreement once. I looked at my attorney, a woman named Frances Odom, who had been practicing family law in Charlotte for 21 years and who sat beside me with the specific composure of someone who has reviewed a situation thoroughly in advance and has arrived at the meeting with a considered view of it. Frances gave me the smallest nod, not approving, not disapproving, the nod of a woman who has given her client a thorough briefing and is now watching her client decide whether she has absorbed it. I looked at Mitchell. He was watching me the way he had watched me across tables for 7 years of marriage, with the confidence of a man who expected the room to organize itself around his expectations. I picked up the pen. I signed. I slid the agreement back across the table. I said, "Thank you." Mitchell's attorney looked at me. Mitchell looked at me. Frances gathered her papers with the careful efficiency of a woman who had prepared for exactly this outcome and was now moving on to the next phase of the work. I stood up. I put on my coat. I walked out of the conference room into the February morning in Charlotte, where the sky had the specific, flat, gray quality of a city in winter that has decided the winter is almost over and is managing the transition at its own pace. I stood on the sidewalk for a moment. Then I smiled, not for the conference room, not for Mitchell or his attorney or the February morning or anyone who might have been watching, but the private smile of a woman who has spent 14 months understanding the full arithmetic of a situation that her husband has understood only partially, and who has watched the partial understanding produce a settlement agreement that is, in her professional assessment, the best possible outcome for her and the worst possible one for him, and who is now standing on a sidewalk in February with $4,200 in a joint checking account and the specific knowledge of everything else. Before I take you back to the beginning, please take a moment to like and subscribe, but only if this story genuinely stays with you. Drop your city and the time in the comments. I always love knowing where you're watching from. My name is Paige Callahan. I'm 36 years old. I am a certified public accountant at a regional accounting firm in Charlotte, North Carolina, where I have spent 10 years doing the specific work of understanding what numbers actually say, not what they appear to say, not what the person who arranged them wants them to say, but what they say when you follow them completely through the ledger from entry to outcome. I do this work for businesses and for individuals and for the estates of people who died with financial situations more complicated than their families understood. And I am good at it in the way that accountants who love the work are good at it, not because the numbers are interesting in themselves, but because what the numbers reveal about decisions and priorities and the specific distance between intention and outcome is always interesting, always more specific than the story people tell. about it. Always cleaner than the mess it comes from. I mention this because it is the complete explanation for why I smiled on a February sidewalk with $4,200 in a joint checking account and said thank you to a man who believed he had taken everything. He had not taken everything. He had taken the part of everything that was visible from where he was standing, which was the part of everything that was worth less than it appeared. This is the story of the 7 years and the 14 months and the settlement agreement, and what Mitchell did not know. Let me take you back to Charlotte, North Carolina, the year Mitchell and I met. I was 28, in my 5th year at the firm, beginning to build the client roster that would become the foundation of the practice I now have. Mitchell Drury was 31, a sales director at a commercial real estate software company, confident and social and skilled in the specific way of people whose profession requires them to read rooms and find the version of themselves that the room responds to best. He was good at this. The version of himself he offered in the early years of our relationship was warm and generous and attentive in the ways that counted when attention was what I was measuring. We married at 31 and 34. The wedding was beautiful, which Pamela, Mitchell's mother, had organized with the specific competence of a woman who had been planning this wedding since Mitchell was approximately 9 years old, and who had views about every aspect of it that she expressed with the warmth of someone who believes that warmth makes the expressing acceptable. I had views too. The wedding was the first occasion on which the gap between my views and the executed version was noticeable, and the second occasion on which the gap was smoothed over with the warmth that Pamela and Mitchell both deployed in situations where a gap had appeared. The marriage had 7 years. I do not want to perform the pretense that 7 years of marriage compress cleanly into a narrative of when things went wrong and why, because that pretense does not honor the complexity of what 7 years is, which is 7 years, the good periods and the difficult ones, and the accumulated small decisions that are the real architecture of a marriage rather than the dramatic events people tend to use as the organizing principle when they describe one. What I can say with the precision that I apply to professional accounting is this: the marriage had a financial architecture, and the financial architecture had a shape that was not apparent to me when I entered it, but became apparent across 7 years of living inside it. Mitchell earned well and spent completely. He understood money as a resource for the present and not as a structure for the future, which is a legitimate philosophy, and one that I had not understood would be his before we married, and one that was in combination with my own philosophy, which was the inverse, a significant and sustaining source of friction across 7 years. The house on Carmichael Drive was Mitchell's choice, larger than I had wanted, more expensive than I had budgeted for, at a time in the rate cycle that my professional instincts told me was the wrong time to take on a large fixed payment. The renovation was Mitchell's choice, specific, expensive, requiring the home equity line that we drew on in 2021 at a rate that I had put into a spreadsheet and shown him twice. The investment decisions in the brokerage account, the trades that generated the capital gains liability, were Mitchell's, made in the specific confidence of a man who had watched the market for 3 years and believed his pattern recognition was superior to the index fund strategy one had been advocating since we opened the account. He was not a bad person. I want to say that clearly and mean it, because the story of a divorce can be told as the story of a villain, and I am not telling it that way. Mitchell was a person whose relationship with money was organized around the visible and the immediate, and whose understanding of winning was organized around getting more of the visible things than the other person, and whose confidence in his own assessment was high enough that he did not examine what he did not examine. That combination of characteristics produced the settlement agreement. I did not produce it. He and his attorney produced it, with the specific confidence of people who had looked at the list of assets and concluded that the list represented what there was, and had built an agreement around that conclusion. The list did not represent what there was. Let me tell you about Aunt Ruth. Ruth Callahan was my father's older sister, 68 years old, a retired high school English teacher who had lived for 40 years in a small house in Concord, North Carolina, 20 miles northeast of Charlotte, and who had never married and had no children, and who had, across 4 decades of a teacher's salary carefully managed and a mortgage paid off in 2004, and the specific frugality of a woman for whom enough had always been enough, accumulated a financial position that no one in the family fully understood until her estate attorney, a man named Gerald Park in Concord, had called me in the fall of my first married year to tell me that Aunt Ruth had updated her will and wanted me to know, while she was still alive to explain it, what the update contained. The update contained a rental property in the Midwood neighborhood of Charlotte, a 2-bedroom craftsman that Ruth had purchased in 2009 at the bottom of the market for $142,000, and that was now worth $387,000. Held free and clear, no mortgage, designated specifically to Page and Callahan, without condition and without obligation. Ruth had purchased the property in 2009 as an investment and had been renting it through a property management company since 2011. It generated $1,850 per month in net rental income. It was in Ruth's name and was going to be in my name when Ruth died. And Ruth was telling me now because she wanted me to understand what she was giving me, and why before the document did the telling on its own. I had driven to Concord to see Ruth on a Sunday afternoon in October of that first married year. We had sat at her kitchen table with coffee, and she had explained the property and the rental income and the management company, and the property manager named Donna, who had been handling the tenants since 2011, and who was, Ruth said, the most reliably competent person she had worked with in 50 years of professional life. She said she was leaving me the property because she had watched me since I was a child and had understood that I was the kind of person who would know what to do with a thing that needed taking care of, and that knowing what to do with things was the quality she most valued. I asked whether Mitchell knew about the property. Ruth looked at me across the kitchen table with the expression she had used in 40 years of teaching when a student had said something that revealed more than the student intended. She said, "Do you want him to?" I sat with that question for a moment. I told her I would think about it. I drove home to Charlotte and I thought about it for 3 weeks, and I decided that the property was mine. Ruth had said specifically mine, without condition and without obligation, and that the decision of whether to disclose it to Mitchell was mine to make, and that I was going to make it after I had thought carefully about what kind of marriage we had, and whether the kind of marriage we had was the kind where this kind of disclosure was necessary. I spent the first year thinking carefully about what kind of marriage we had. The first year was followed by 6 more, during which I continued thinking carefully, and the thinking did not produce reassurance about the kind of marriage we had. And the reassurance's absence was not a decision I made about disclosure, but a fact I lived inside until the fact became the context for everything that followed. Ruth died in the spring of the 5th married year. Gerald Park called me on a Tuesday morning at work. I went to Concord that weekend. The Midwood craftsman, by the time of Ruth's death, was worth $372,000. The market had moved slightly since the 2021 high, and the rental income had continued uninterrupted throughout, managed by Donna with the reliability Ruth had described. The title transferred to my name through the probate process. The property was in my name alone, and Mitchell had signed nothing, and was a party to nothing because the property had never been described to him and had never been a joint asset, and was, under North Carolina law governing separate property received through inheritance, mine alone, and not subject to equitable distribution. The marriage ended in the 6th year. The ending was not a single event. It was the accumulation of the events that had been accumulating, arriving finally at the weight that produced the acknowledgement that the accumulation had been trying to produce for a long time. Mitchell and I separated in December. I called Francis Odom in January. Now, here is the question I want to ask you before I tell you what the 14 months between January and the February settlement contained, because I have been asked this question by every person who has heard this story, and I want to hear your answer. I knew from the moment Mitchell and I separated that the settlement was going to be organized around the visible assets, the house, the brokerage account, the cars, the checking account. I knew that Mitchell did not know about the Midwood property, and that Mitchell's attorney, working from the financial disclosure Mitchell provided, would not know about it either, unless I disclosed it voluntarily. The question is, was I obligated to disclose it? I knew what the law said. Separate property received by inheritance is not subject to equitable distribution and does not need to be included in the settlement. I knew what the law said. What I want to know from you is what you would have done with what you knew. Because the answer to that question is different from the legal answer. And it is the question that actually mattered when I was sitting in my Charlotte apartment in the first months of the separation trying to decide what kind of person I was and what that kind of person did in this situation. Tell me in the comments. Frances confirmed what I knew. The Midwood property was separate property and was not required to be disclosed in the equitable distribution. She confirmed that the rental income one had been receiving, deposited into a personal account I had opened in my name in the year of Ruth's death, was similarly separate and similarly not subject to distribution. She confirmed that the financial disclosure I was required to provide would include the joint assets, the house, the brokerage account, the cars, the checking account, and would not require inclusion of separately owned inherited property. She reviewed Mitchell's financial disclosure when it was produced and confirmed that Mitchell had disclosed the same joint assets I had disclosed and had not identified any additional assets I was unaware of, which told me that the financial picture Mitchell understood was the financial picture of the joint assets and that nothing else had been building anywhere that I was not aware of. What Frances also did during the 14 months of the separation was advise me to review the joint assets carefully so that I understood exactly what I was agreeing to relinquish when the settlement arrived. I had already reviewed them. I had been reviewing them since the beginning of the separation with the specific attention of a CPA who does this kind of analysis professionally and who was now doing it for herself, which gave it a particular and concentrated quality. The house on Carmichael Drive, mortgage balance $412,000, current market value approximately $440,000, equity approximately $28,000, against which the home equity line balance of $88,000 had been borrowed, making the true equity position approximately negative $60,000 before closing costs. The BMW, leased, 14 months remaining, no equity, Mitchell's name on the lease. The Subaru, same. The brokerage account, $67,000 nominal value, capital gains tax liability of approximately $18,000 due in April, net value approximately $49,000. The joint checking account, $4,200. The total net value of the assets Mitchell was claiming. I had calculated it at approximately $4,200 in actual liquid value, with the house representing a negative equity position when the HELOC was factored in, the brokerage account representing a net of $49,000 after the April tax liability, and both cars representing obligations rather than assets. The furniture and tools and grill were real assets worth approximately whatever the used market would pay for them, which I had estimated at $8,000 in a charitable assessment. Mitchell believed he had the house, the investments, the cars, and the possessions. He had the mortgage, the HELOC, the capital gains liability, the lease obligations, and the possessions. The difference between what he believed he had and what he had was the difference between the visible surface of a set of assets and their actual financial substance, which was the difference I had been documenting in my professional life every day for 10 years and which I had now documented for my personal life with the same precision. Frances had reviewed my analysis. She had had her own financial expert review it. The expert agreed with my numbers within a margin of error that was professionally acceptable. Frances said, "He's going to take the worst side of every asset." She said it with the professional neutrality of someone who is not celebrating a client's outcome, but is accurately describing what the outcome was. What Mitchell's attorney did not know, because Mitchell did not know, was the Midwood property, which was worth $372,000 free and clear and generated $1,850 per month. What Mitchell's attorney did not know was the personal savings account I had opened in my name after Ruth died, into which I had deposited 62 months of rental income totaling $114,700, minus property taxes and the management company's fee, for a net balance at the time of the settlement of $96,400. What Mitchell's attorney did not know was that the firm's partner track, which I had been on for 3 years, and which was not a joint marital asset but was a professional development that had its own financial implications, had produced an equity stake in the firm that would vest in the following spring, and that was, again, mine alone. The settlement agreement gave Mitchell the visible things. I signed it. I said thank you. The thank you was genuine. I was thanking him specifically for his consistent and reliable confidence in his own partial view, for the 7 years of financial decisions made from the certainty that he understood what there was, and for the settlement strategy organized around the certainty that he understood what there was, and for the resulting agreement that had given me $4,200 in a checking account and left him with a negative equity house, a tax liability, 2 lease obligations, and a home equity line charging. Variable interest. The thank you was for all of it, for every decision he had made from confidence rather than from examination, for showing me, across 7 years, what happens when a person stops at the visible surface and does not ask what the surface is sitting on. Let me tell you where everyone is now. The Midwood craftsman in the Carmichael neighborhood is mine. Donna manages it with the reliability Ruth described, and that I have confirmed across 5 years of working with her directly. The tenants in the current lease are a young couple who are excellent, pay early, maintain the property carefully, and who sent a note in December saying they hope to extend for another 2 years. I told Donna to offer them the extension. They signed. The property's current market value is $401,000. The rental income deposits into the account with my name on it. The personal savings account has $118,000 in it. It will have more in the spring when the equity stake in the firm vests, and more still as the rental income continues to arrive on the first of the month with the reliability of a thing that has been running correctly for a long time. The house on Carmichael Drive sold in August, 8 months after the settlement. Mitchell had listed it in April, which was also the month his capital gains tax bill arrived. The house sold for $441,000, from which the $412,000 mortgage was paid, and the $88,000 HELOC was paid, producing a deficit of approximately $59,000 after closing costs that Mitchell was required to cover from the brokerage account, leaving him with approximately $9,000 in the brokerage account after the tax liability and the deficit were addressed. I know this not because Mitchell told me, but because home sales and mortgages and home equity lines are matters of public record, and I am a CPA with access to public records, which is not the same as stalking, but is the same as professional habit. Frances Odom called me in September. She said, "He figured it out." I asked what had happened. She said Mitchell had apparently been reviewing the public records of Ruth's estate, which are also public, and had found the Midwood property and the title transfer. He had called his attorney. His attorney had called Frances. His attorney's position was that I had concealed an asset. Frances's position, which she delivered to his attorney in the flat, specific language she used when her position was unassailable, was that Ruth's property had been separate inherited property under North Carolina law, that it had been correctly excluded from the financial disclosure, that the settlement agreement had been entered into voluntarily by both parties with independent counsel, and that his client was free to consult a second attorney if he wanted a second opinion on North Carolina's separate property statute, which had been settled law for several decades, and which Francis had available in a tabbed exhibit if his attorney needed a citation. The attorney did not pursue it further. Mitchell called me once. I answered because Francis had told me that if he called it was better to answer than to let the call go to a voicemail he might characterize in some subsequent proceeding as me evading communication. His voice had the quality of a man who has done the arithmetic for the first time and has arrived at the answer that I had arrived at 14 months earlier. He said, "You knew," not as an accusation, as a statement of the fact. I told him I was an accountant. I told him understanding the full picture of a financial situation was what accountants did. He was quiet for a moment. Then, I thought I was taking everything. I said I understood that was what he thought. He said, "The house is a disaster." I told him I was sorry the sale had been complicated. He said, "You let me have the house." I said the settlement agreement had been produced by him and his attorney, and I had agreed to it, which was accurate. He said, "You knew the house was negative equity." I said I had done the math. Yes. Another silence. Then, that was smart. He said it without bitterness and without admiration, with the flat recognition of a man who has encountered a thing that was done correctly and is acknowledging it as a fact. I said thank you. He said goodbye. That was the last conversation we had. My sister, Claire, visited from Asheville in October. Claire had known about the Midwood property from the year Ruth died. I had told her because Claire was the person in the family I told things to, and because keeping the inheritance from Claire would have been the wrong kind of secrecy, different from keeping it from Mitchell in the way that all family secrets are not the same secret. Claire had watched the whole 7 years from Asheville with the specific patience of a sister who understands that the person in the marriage has to arrive at the marriage's conclusion on their own terms and at their own pace, and who offers what is asked of her, and does not offer what is not asked. She had offered in 7 years 3 meals at her kitchen table when I needed to sit somewhere that was not mine, and not Mitchell's, 2 phone calls in the middle of the night that I had made without fully explaining, and that she had answered without requiring the explanation, and 1 conversation in the fall of the 6th year where she said, without having been asked directly, "You know where you are. You're just deciding when." That was the most accurate sentence anyone said to me during the marriage. She sat at my kitchen table in October. My kitchen table, in the apartment I had moved into after the settlement, the apartment on Park Road in Charlotte with the south-facing window that gets the afternoon light that I had specifically chosen. And she said, "Tell me about the thank you." I told her about the conference room and the settlement agreement and the February sidewalk, and the private smile. She listened to all of it the way Claire listened to everything, which was completely and without commentary until she had the full picture and had considered it. Then she said, "Aunt Ruth would have loved this story." She said it with the warmth of someone who is right about the person they are describing. I told her I thought about Ruth often. She said she knew. She said, "Ruth saw it in you before you saw it in yourself." I said I thought that was what people who paid attention did. They saw things before the person they were seeing was ready to see them in themselves. And the seeing was the gift, and what you did with the gift was the rest of the story. We sat for a while at the kitchen table in the afternoon light from the south window, and did not say much. Some things do not need more saying once they have been said correctly. Claire left at 6. I sat at the table for a while after she was gone and thought about Ruth at her kitchen table in concord with the coffee, and about the October afternoon when Ruth had told me what the property was and what she was doing with it, and about the question she had asked, "Do you want him to know?" and about the years I had spent understanding the answer to that question, and about the February morning and the conference table and the settlement agreement and the pen and the specific private quality of a thank you that was entirely mine. Here is what I want to say before I go. There is a specific kind of confidence that believes it sees everything in a room and stops looking because the seeing has already been confirmed. Mitchell had that confidence. It was one of the qualities that had drawn me to him at 28, the ease of a man who moved through rooms as though the rooms had been arranged for him, and it was one of the qualities that had, across 7 years of marriage to an accountant, never been adequately applied to the question of what an accountant might know that he did not. He looked at the list of joint assets and saw what there was. He did not ask whether the list was complete. He built a settlement strategy around the list. He took the list. He said, "Thank you," was an odd response from someone who had just lost everything. I said thank you because I had not lost everything. I had lost the visible surface, which was the part worth losing, and I had kept the part worth keeping, which was the part Ruth had given me and the part one had built on it, and the part that was in an account with my name on it, and a property in my name, and a professional future in my name, and an afternoon light from a south-facing window that was specifically and entirely mine. I had also kept the 10 years of professional training that had allowed me to understand the full arithmetic while my husband understood the partial one, and the clarity of mind that had produced the decision to wait for the settlement he would choose to offer rather than the settlement he would be required to accept if I had argued, and the specific satisfaction of watching a man who was confident he understood the complete picture discover that the picture had more to it than his confidence had accommodated. The thank you was for all of that, for the education, for the clarity, for Aunt Ruth and Donna, and Francis Odom and the Midwood craftsman, and the south window, and the table where Claire sat in October and said what she said, for the February morning, and the flat gray sky becoming something else at its own pace, for being, at 36, the specific kind of person who does the full arithmetic and understands the complete picture and knows that the surface of a thing and the thing itself are related but not identical, and that the difference between them is always in the numbers. Find the numbers. Read them completely. Know what you have. Then smile and say thank you. My name is Paige Callahan. I am 36 years old. My husband signed a settlement agreement giving himself the house with the negative equity, the brokerage account with the capital gains bill, the cars with the lease obligations, and the home equity line with the variable rate. I signed away my claim to all of it. I said thank you. I walked out into the February morning in Charlotte. The Midwood craftsman is at $401,000. The tenants signed the extension. The south window gets the afternoon light. The numbers are correct. They have always been correct. Thank you for staying until the very end. If you have ever understood the complete picture while someone else understood only the surface, and let the surface speak for itself, drop a comment. Tell me what the thank you felt like when you finally said it. I read every single one. If this story found you in a moment where someone is confident they see everything you have, share it with the person who needs to hear that the list is never the complete accounting and that the accountant always knows. Like, subscribe, and I'll see you in the next one.